The stock market often seems intimidating, reserved for finance professionals or the ultra wealthy. But in reality, anyone can build wealth through investing with the right approach. You don't need complex strategies or insider knowledge, just a few disciplined steps that can set you on the path to financial success. In this video, we will break down 7 proven strategies that can help you grow your investment steadily and sustainably. Let's get started. Hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. A common misconception is that investing requires a significant amount of capital. In reality, even a small, consistent investment can yield substantial long-term returns. Example, the power of 100 rupees per day. Like if you invest just 100 rupees per day in an equity mutual fund with an average annual return of 12%, here's what your wealth would look over time. As you can see presented on the screen, there's a tabular column that depicts how your wealth could look over time. So in 10-year period, the total amount you would have invested would be 3.65 lakh, but the estimated value at 12% return is 7.07 lakh. In 20 years, your investment is 7.3 lakhs, but estimated value is 24.2 lakhs. And in 30 years, the total investment is 10.95 lakhs, but your estimated value is 1.05 crore. And in 40 years, your total investment is 14.6 lakhs, but estimated value is 3.5 crore. Why does this work? Small regular contributions accumulate over time. So compounding allows your returns to generate further returns. A systematic approach like this builds financial discipline. The key takeaway here is investing doesn't require large sums, it requires consistency. So one of the most successful investors, Warren Buffett, follows a simple principle. Invest in businesses you understand. So before investing in a company, ask yourself, do I understand its business model? Does the company have a competitive advantage? Is there long-term demand for its products or services? For instance, if you frequently use consumer tech products, financial services, or FMCG brands, you may already have insight into their growth potential. Why does this work? Familiarity with the company helps you make informed decisions. Investing in well-known businesses reduces uncertainty, and confidence in your investments help you stay invested long term. So the key takeaway here is invest in companies you genuinely believe in rather than chasing trends. The most effective investors eliminate emotions from their decision making. Automation ensures that investing remains a priority regardless of market conditions. So how to automate your investments effectively? First, systematic investment plan. SIP, which is to invest a fixed amount in mutual funds through SIP at regular interval. Then direct debit setup. So ensure your funds are automatically invested each month. Why does this work? You invest regardless of market fluctuation, so it removes emotional bias in your investment decision. It ensures consistency, which is critical for long-term success, and also helps you avoid market timing mistakes as investments are spread over time. So the key takeaway here is a well-structured investment plan removes uncertainty and builds discipline. Diversification is essential, but overcomplicating your investment portfolio can lead to inefficiency. An effective diversification strategy would include investing in equity mutual funds like large cap, mid cap, and even index funds, and also investing in direct stocks as a way to diversify your investment, because investing in a handful of well-researched company stocks would also help you in the long run. Also investing in debt instruments as a safety investment, because fixed deposits or bonds are helpful for stability in your portfolio. So why does this work? Diversification reduces exposure to market fluctuations. It balances risk while allowing growth opportunities. So a simplified portfolio is easier to manage and track. So the key takeaway here is balance risk and reward without overcomplicating your investment. And many investors seek quick gains, but the most significant wealth is built through patience and compounding. Consider this: the stock market experiences volatility, but history shows that long-term investors tend to benefit. Market downturns or temporary, quality investments recover over time. So staying invested for decades allows for exponential wealth accumulation. Why does this work? Compounding has a multiplicative effect on returns. A long-term view reduces stress from short-term market fluctuations. Investors who remain patient outperform those who attempt to time the market. So the key takeaway here is time in the market is more important than timing the market, and market swings often trigger emotional reactions. So investors tend to panic sell during downturn or chase stocks during market peak. So instead of reacting emotionally, stick to a well-defined investment strategy. Focus on long-term trends, not short-term movements, and rebalance your portfolio periodically instead of making impulsive decisions. Why does this work? It prevents buying high and selling low, which is the opposite of a successful strategy. It encourages rational decision making based on fundamentals, and it helps investors stay invested even in volatile market. So the key takeaway here is investing should be based on logic, not emotion. So continuous learning is essential, but over-analyzing can lead to indecision. So to build knowledge effectively, read investment books, research reports, and market trends. Follow experienced investors, but avoid blindly copying them. Consume content in moderation. Don't let too much information paralyze you. Why does this work? It keeps you informed without overcomplicating investment choices, helps you develop independent decision making skills, prevents analysis paralysis where excessive data leads to inaction. So the key takeaway here is learn continuously but focus on applying knowledge. Let me tell you a real life example. This is the 500 rupee investment success story. So meet Arjun, a 25-year-old who had never invested before. He started with just 500 rupee per month in a mutual fund SIP. Every year he increased his SIP by 20%, but he remained invested for 30 plus years without withdrawing funds. 30 years later, his disciplined strategy grew into 1.76 crore. 35 years later, his portfolio reached 4.6 crore. So Arjun's story highlights the power of starting small, staying consistent, and allowing compounding to work out in your favor. So building wealth in the stock market is not about timing the market or chasing trends. It's about discipline, patience, and consistency. By following these 7 strategies, you can reduce risk, maximize returns, and achieve long-term financial success. Take the first step today. Start small, stay consistent, and let time work in your favor. If you need professional guidance like this in your investment and financial decision, then click the link in the description below to register for a free consultation with one of our certified financial planner. If you found this video helpful, like, subscribe, and share for more insights on investing and financial growth. Thank you for watching.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.